Sorry for disturbance. So, as a business person, our main motive will be to know whether our business is earning profits or not. So, how we will find whether we earn profits or loss with the help of preparing or maintaining accounts or books of records. So, what are those records? How actually it has been taken place? What are the different situations that all we will try to understand? So, in that due course, if you can just look at here, we have 5 blocks. In the block 1, financial accounting, block 2, final accounts, block 3, cost accounting, and block 4 is understanding financial statements, and block 5 talks about reporting system. So now first we'll try to understand the financial accounting and its introduction, what is double entry system, what are the subsidiary books, and trial balance and rectification of errors. So in the block 1, apart from that, even they given some theoretical part, that is unit 1, which talks about financial accounting introduction part, in which they will give the definition of accounting, its advantages, disadvantages, limitations, what are the branches of accounting, uses of accounting information. That all will be discussed in the unit 1, that is block 1. Under that, we have unit 1, which is theoretical part. So when you talk about accounts, we have different definitions given by the different persons. So as I termed, every business wants to know the result of their activities or whatever the activities they are doing throughout the year, whether their business is going in profits or under losses. So in that, you can just look at here, we have a glance. We have different definition that is given by American Institute of Certified Public Accountants, American Accounting Association, and also the Accounting Principles Board of American Institute of Certified Public Accountants. Apart from this, if you can just look at that, for the 3 different institutes which are giving definition about the accounting. Apart from them, we have 2 persons who's called Smith and Ashburn. We are telling that accounting is a means of measuring and reporting the results of economic activities. Means whatever the business activities we are doing, what is the result, that will tell, accounts will tell about that one. So this is the account definition. And when you look at the functions, actually this is the actual definition which they made it as function. If you just look at here, this one, recording, classifying, summarizing. See, this recording, classifying, summarizing, analyzing, and interpreting the outcome, and the last one is reporting. So this all together, when we put together this all together, that is nothing but the definition of financial accounting or definition of accounting. So accounting is nothing but recording. It is the art of recording, classifying, summarizing, analyzing, and interpreting the outcome and giving its a report. So what we are recording, if you just look at here, recording we are calling. Yes, recording means whatever the monetary transaction that takes place or monetary activities that takes place in the daily in the business, that will be recorded. Where do we record? We record in a book, that too in orderly manner, means in a order wise. And that book is called the first, wherever we write whatever transaction or the activity that is taking place and which is measurable in monetary terms, that is called journal. We write entry, for example, I am selling some goods or purchasing some goods. What shall I do? In that case, I will write in one book that today goods sold or purchased, given salaries, like that daily activities, whatever are taking place, that I am recording in a book, that is called as journal. Next, we have classifying. Now, for example, I am purchasing the goods from one of the supplier, alternatively or every 5 days or 10 days. In that case, I want to know how many times I'm purchasing from him. Maybe monthly twice or monthly thrice, means yearly how many times it will be. So what is the amount I have to pay him? What is the amount actually? For example, if I am selling the goods to the customers on the credit basis, I want to know what are the uh, amount I have to receive from the customer. So in that way, I just want to know. Then how I will know? By classifying them, means separating them. How do I separate them? I separate by preparing an account that is called ledger. So first what I am doing, I am recording the entries. Then I am separating them based on the number of transactions from the same person, that is classifying. Next I am doing is summarizing. What I am doing? I am doing summarizing. So how do I am summarizing? You can just look at here. By preparing, so first I'm writing, then classifying. Whatever I'm recording, I'm calling it as journal entries. Whatever I'm separating or segregating them, I am calling them as ledger. Now, when I am trying to find out, now I want to know, okay, I've separated now. Now I want to know Mr. X, from him how many goods I've purchased. So how do I know? I'll put all them together and find out what is the balance actually, that is called trial balance. Next, I am going to analyze and interpret also. So only by just looking that, everyone will not understand, because every business person will not be an accountant, may not be, but it must be known. For example, anyone is investing in another organization. As an investor, I wanted to know whether that organization, how it is performing, what are its assets, what are its liabilities. That is possible through summarizing. Next comes analyzing and interpreting. Whatever the outcome that has come, now I want to know whether I'm able to, means I have to tell or write a report stating that this is interpretation, means the business is performing good, the business is not performing. This total all together we call it as definition. Put together. So accounting is the recording, classifying, summarizing, analyzing, interpreting the outcome, and giving the report. Report means financial report, stating that this is the position of the business, or this is the how the business is working. Is it clear?
Yeah.
Yeah. Next comes bookkeeping versus accounting. So just now we have understood what is the definition of accounting. Now what is bookkeeping? It's almost little, means we have a very slight difference between the bookkeeping and accounting. In bookkeeping, only they record the transactions. They will not analyze, they will not prepare separate accounts, they will not find out their outcome, what is their outcome. They'll not interpret. These all activities will not done in bookkeeping. Whereas in accounting, they will write, means they will record, they will classify, they will summarize, they will interpret, and also they will give the outcome of that report. So that is the difference between the bookkeeping and accounting. And next, they given evaluation of accounting. So maybe many people say that Luca Paciolo is the person who termed the world called accountancy. But when you take Mahabharat and also Arthashastra written by the Chanakya, where he talked about the financial position of any organization that were done long ago before this Luca Paciolo has proposed in 1494. This the term accounts has been come into picture, but late before that, even Chanakya also mentioned in his Arthashastra about the financial and accounts. And the advantages of financial accounting, if you look at your aid to management, means see these all advantages, whatever they given, is very simple if you understand. That is aid to management means this all will help the management. How accounts will help the management? Because when you do prepare some accounts, you will know which department is performing well, which department is not performing well. This all is possible, and management means the owner of that organization can understand easily with the help of the financial accounting. And also the other advantage is systematic recording. Why? Because in a financial accounting, they have some certain chronological formats where they prepare the accounts. Like first they will write journal entries, then they move to the ledger accounts, then comes the trial balance in the mid subsidiary books. Like this, there is a chain of books where they prepare it and find out the position of that, means there is a documents that are available. Next, we have performance assessment. With financial accounting, even helps the management to assess the organization and also its performance analysis. We can even find out with the help of cash flow statement, funds flow statement, and all comparative statements. And it also helps the ascertaining the value of the business. So even it helps in the ascertaining the value, means when you go for liquidation, means closing of any business, or if you want to merge with one bank with the other bank. For example, we have merger. Yes, banks were being merged earlier. Now, earlier it was SBH, now it is SBI. Earlier it was Andhra Bank, now it is Union Bank. So, what happened to these banks? This all banks have been merged with SBH, has merged with SBI. So, when this merger is taking place between two banks, the bank which is taking that or trying to merge with the other bank, they want to know the financial position, and this can be understood with the help of financial accounting. And also ascertaining the value of business helps in abiding the rules. Financial check means any fraud is taking place or any corruption has been taking place, any embezzlement of cash or funds are been going on in the business or not, or whether the means financial accounting will help them to prevent all this. And basis for cost accounting and management accounting. Why? Because cost accounting mostly will be done by the manufacturing organization where they have manufacturing unit. Then only they'll prepare the cost accounting. And management accounting, these two, means financial accounting will help the organization and it will become a basis for preparing the cost accounting and management accounting. Next, we have limitations. That were the advantages of financial accounting. And apart from that, even we have limitations. When you talk about limitations, we have monetary transactions because it takes only into the consideration of monetary. Then what about non-monetary transaction, which cannot be quantified into money value? Do you think the transactions which do not have monetary value does not exist? No, they exist in the organization. But when they are preparing financial accounting or when they are doing accounts, this will not be taken into consideration. This is one of the drawback of financial accounting. And historical data, for example, not example, actually financial accounts, ledger journal entry will be written every day. Why? Because whatever transaction takes place, that will be noted down. And but when I will prepare my final accounts, when I want to pay the tax, that is either the end of the financial year. So when is the financial year ending? At that time, what I'm doing, whatever activities I have done from April to March, I am doing it on March. I am finding its value whether I got profit or not in the month of March. Means what I am taking historical data which is already done. See, I purchased some goods in the month of June. Actually, when I'm preparing accounts in the month of March of next year, if I think that, array, I should have that taken, instead of taking this, I should have not purchased from the supplier. Can I change that, go back to June month and do? No, it's not possible. Means the activities which are already done, that cannot be changed. So accounts are prepared on based of historical data. Next, fluctuation in prices are not considered. Why? Because whenever we are preparing the accounts, it will be end date, and maybe, for example, if you take the iPhone present rate may not be different, or 1 year back the phone rate might be different. But what I'm doing, whatever transaction has taken place in that year only, I'm writing now. Means last 11 months the rate was different, now after 11 months the rate is different. But still what I'm doing, I'm not taking the fluctuation, the change of rate is not taken into consideration while preparing financial accounting. Next, personal bias. Why? Because statements are prepared by, because it will even judge affect the organization in the method of treating depreciation or valuation of stock. So because every organization, if they are following different method, that will affect the organization. And insufficient details, only by looking at the financial statement. If you just take any newspaper of business newspaper, you will be finding the published financial reports of certain organization. If you just look at that, we cannot give proper report on that statement only by looking at that final accounts, which is not sufficient to analyze any organization. So apart from financial accounting, we need additional accounts like cost accounting, management accounting, inflation accounting, human resource accounting. Like this means only with the help of all these accounts, we can give the correct and appropriate analysis of any organization. So these are the limitations. Next come the branches. Just now we discussed, apart from financial accounting, we have management accounting, cost accounting, human resource accounting, inflation accounting, and responsible accounting, social accounting, forensic accounting. Next, who are the users of accounting information? For whom it is useful? Can anyone tell? Is it able to understand which people, for whom we are preparing financial accounts? Okay, as a owner, I want to know. So for my purpose also, I want to know. So that is the reason I'm preparing the accounts. Apart from the owner, do we have any other persons or people who are interested in financial reports? Yes, we have, like, if we can just, like, investors, the people
Investors.
who, yeah, investors who invest in the organization, they want to know why, because whatever the funds they have invested, they want to know that, they want to find out what is happening with their amount. Is it used properly or not? Now, similarly, even creditors means the people who have sold material to us or from whom we purchased goods on credit basis. Even whatever business you take, first we have to purchase from supplier, then we will sell to the customer. Similarly, whenever we are purchasing from supplier, even he wants to know, I am selling goods to this company, then company is able to give me the goods back or not, or give the amount back on time or not. If the company is under losses, should I sell my goods to that company or not? When consumers, yes, investors, suppliers, creditors, employees also wants to know whether organization is in profits or in losses. If it goes in losses, what they have to do. That all means these are the different people. Even government also want to know if some product has having more value, whether what is the tax rates that are going to affect that organization. So these are the different people who are interested in the accounting information of our business. So that is about introduction part. Now comes the double entry system. Means here, for example, if you take a vegetable vendor who starts his business in the morning, vegetable vendor. You go to the market, he will purchase the vegetables and start selling in every street. And in the afternoon, means when he goes for purchasing goods, he have to give some amount to the vendor, and he will purchase the that vegetables and start selling in the different streets. In the afternoon, he may feel hungry. Whatever vegetables is selling, he takes some amount, he eats. Then again, he thinks, are a vegetable. If all vegetables have been sold, again he will think, let me purchase some more vegetables. So we will go to the market. Again, he will purchase some more vegetables and he start selling till evening. Do the vegetable vendor maintain any accounts? No. Any vegetable small vendor will not maintain any accounts. If they have a small shop also, what they'll do, they will only see that to whom they have sold on credit basis. Credit means they will sell now and the customer will give the amount later time. That is called credit sales. So they will write only the person name to whom they sold the goods on credit basis. And also they write only from whom they purchased the goods. That's it. Only two things. From whom they have purchased the goods and from for to whom they have sold the goods. Only to these two people information they will store. They will not remember any other person. So this type of accounts are called single entry system, where there is only one effect is taken into consideration. The two effects are not taken into consideration. They have taken only one effect has been taken into the consideration. Now, what is double entry system? For every transaction, for example, I am selling goods to X. Selling goods to X. So when I am selling goods, goods are means I am giving goods to the customer. What customer will give me? Yes, what customer will give me?
Money.
Money. So there are two effects. Goods are going, we are giving goods to the customer, and customer is giving us money. So here two activities are taking place, two transactions are taking place. In one transaction only, two activities are taking place. That is, one is going effect, the other one is receiving effect. This is called double entry system. This is called double entry system, where there will be two effects. One is giving effect, the other one is receiving effect. One is giving effect and the other one is receiving effect. That is called double entry system. And again here they are calling it as cash basis or mercantile. Cash basis means I am selling the goods. For example, if you go to any stationery shop or purchase some pen, we give immediately cash and take the pen. That is cash basis. And mercantile or accrual basis means, for example, daily we take milk from the neighboring shop or some milk person comes. What we will do, will not give amount daily. At the at the end of the month, we pay that amount. That is called credit basis. Or sometimes they maintain even mixed or hybrid. It may be sometimes cash basis or sometimes it is accrued basis. So that is double entry system. Next, for any accounts to write, why this is because theoretical part foundation is very, very important in order to understand the problems in the further. Okay. So that is what I'm giving much time to the theoretical part. So before entering, I said now, whenever we are writing or we are doing any business, I want to know the profit. To know the profit, what I am doing, I am preparing accounts. In accounts, first what I'll do journal. JOURNAL, journal. Means whatever transaction is taking place, I will write in a book that is called journal entry. So when to write this entry, how to write this entry? By taking this all into the consideration. These are called accounting concepts. What do we call them? We call them it as accounting concepts. So in accounting because these are the basis for writing the entries, means for recording these entries. Under that, the first one is business entity concept. Business entity concept. This concept, we have to remember this. Why? Because this concept says that, for example, I have started a kirana store shop or stationery shop area in a small business of my own thing, in which I invested my personal amount and started the business. Normally, what we assume, it is my shop, it's my business, I can do whatever I get the amount, I'll do that. But account says that it's not like that. Though you have started the business, you are different and business is different. Owner is different and business is different. Business is having separate entity, separate identity. So, for example, if you have own shop and whatever amount you take from your shop, do you write anything like accounts? Like, no, we don't write anything because it's our own business. We just take the amount and we use it. Yes, but account says it's not like that's wrong. As per business entity concept, owner and business are two separate different entities, two different persons. So if for example, if owner is taking anything from the business, that is nothing but whatever owner is taking from the business, either in the form of cash or in the form of kind, be cash or kind, that is called as drawings. Whenever owner is taking anything from the business, either in the form of cash or in the form of kind, it is called as drawings. It is assumed as it's an expenditure of the business. It is assumed as the expenditure of the business. Next comes the going concern concept. This concept says that whatever business you start, whichever business you start, it should be started in an assumption that business will run forever. Whether owner exists or do not exist, business will run for infinite period or indefinite period of time. On the basis of this only, we prepare the accounts, and on the basis of this only, we take the value of assets and liabilities. On the basis of this only, we take it into consideration and we do it. Next comes periodicity concept. In accounts, we have 12 months as calendar year. We have even accounts also. For preparing accounts, we take 12 months period of time, and in 12 months period of time, it may be either financial year or it's up to the company's interest or calendar year, but mostly they'll go for financial year. Why? Because they have to even pay the tax and all those things, so they go for the, but it should be see that it should be have 12 months. Next, money measurement concept. Actually, accounts takes only to the consideration of only the transactions which have money, but there are certain things which cannot be measured but have an impact in organization. Yes, money measurement concept says that only the things or the transactions which can be expressed in terms of money will be taken into consideration. Next, we have cost concept, where the stock will be taken on the basis of cost concept, means whatever the cost is there, that will be taken into consideration. Next, dual aspect effect, that is one is debit effect and the credit effect. As I said, giving effect and receiving effect. Matching concept, uh, why? Because it arises because of going concern and periodicity concept. This arises, the both should match each other. So these are the different concepts. And realization concept, and according to this concept, revenue is considered as being earned on the date of which it is realized. So it is considered as income only when it is realized. Otherwise, for example, it to be received, but do we receive? No, we haven't received. So it will be considered as income only when it has received. That is about realization concept. Next comes the objectivity concept. They should be having some objective evidence for every transaction, means they should have some proof. This is all about the concepts. On base of this only, we will write the accounts and we prepare the accounts. Next, we have conventions. So we have concepts and conventions together. We call it as principles, accounting principles. So convention of consistency. So here we should maintain the, for example, what are the rules we are following? For example, we are following depreciation on the concept of some fixed installment method. So the same has to be followed for all years. The whatever method you are following, it should be consistently, it should be same. Next, conservatism. This tells that every business has to be prepared for the contingencies or losses that may occur in the future. This also has to be kept in mind and should be done. Next, convention of disclosure. So these are the different conventions and concepts on based on which we prepare the accounts. Next comes the types of accounts. So to write journal entries, whatever journal entries we write. What is journal entry? Journal entry is nothing but day-to-day transactions. Day-to-day transactions of the business are recorded in a book. Day-to-day transactions of a business or day-to-day activities of a business are recorded in a book that is called, that recording is called journal. And how to write this journal, that now we are going to understand. To write day-to-day activities, whatever business transactions are taking place, when we are noting in a book, that is called journal. To write that, how do we write? What is the procedure to write those journal? Let's see that. In that, first we have type of account, that is normally we call it as two types or you can take three. They are, first one is personal. First one is personal account. Personal means it will take into the consideration of person's name. Ravi, Suresh, Ramesh, Asma, Rahim, Ram, Robert, natural human beings' names. Next come names means only the human beings will be having names? No. College will have name. Some bank will have name. Some company will have name. So that is called artificial persons. That is called artificial persons. Who are those artificial means they have been created by law. They have been registered like TCS company. If you just look at your examples, State Bank of India, L&T company. These are also the names of names of what? Artificial persons means names of any institutions, names of any companies, also called comes under personal account. Next comes the representative persons, where we have different persons, n number of persons, but we cannot write at a place. In that time or in that case, what we will do? For example, I think if you have a knowledge of shares, whoever purchase some shares, the company will not write Ravi 10 shares or Ravi 100 shares. No. They will write in their accounts share capital. Means instead of writing 100 or thousands of shareholders' name, they write only share capital. Next, for example, if you just look at TCS company, they may have thousands of employees. They have to pay salary to them. They cannot write X salary, Y salary, Ramesh salary, Suresh salary, Geeta salary. They will not write every 1,000 person names in a book every month. So what they will write? They will write salaries payable, which are yet to be paid. To whom they have to pay? Salary will pay to employees. But can we take their names? No, we cannot take. So what we will do? Salaries payable. Have we paid? We haven't paid. But to whom we have to pay the salary? To some certain person we have to pay. But can we write those 10,000 or 1,000 people person's name? No, we cannot write. So what we are doing? Salaries, I'm telling. Paid, I'm not telling. Salaries payable, which has not yet paid. So here, personal account means it comes three different persons. One is natural person, artificial person, representative person. So how many persons we have? We have three persons. One is natural person, the other one is artificial person and representative. Natural person means like our names, individual names. Artificial person means bank names, company names, any institution name. That all comes under artificial person's name. Next, we have representative, where we have salaries payable, which has yet not paid. That we will take here. So your person. Then what is the rule? I am telling we will take. How we will take? For example, I am telling this. We have a rule for personal account. Debit the receiver. Debit the receiver. This DR means debit. Debit the receiver. Next, we have credit the giver. As per personal account, debit the receiver and credit the giver. Debit the receiver and credit the giver. Now, to whom we have to debit? The person who is receiving, we will debit that person, and the person who is giving, we will credit that person. Receiving person should be debited, giving person should be debited. For example, A is giving pen to B. A is giving pen to B. Who is receiving here? A is giving pen to B. Who is giving pen to B?
He is giving.
Who is receiver here? B is the receiver. And who is the giver here?
Yeah.
A. So so it's simple that as per person, if any names comes, we have to see that whether is a receiver or a giver. If he's a receiver, we will debit him, and if he's a giver, we will credit it. So, ma'am, you may get it out. Ma'am, what is debiting? Debit the receiver credit? That we will understand once we complete the remaining two types of accounts. Now comes the next one, that is real account. Real means which we can touch, feel, and sense, and which is tangible thing, which we can see with our naked eyes, which we can touch, see, and feel them. That is called real account. For example, bench. Can we see the bench? Yes?
Yes.
Yeah. Chair. Can we see the chair? Can we see the chair? Yes,
Yes, we can see the
we
chair.
can see the chair. Can we touch the cash? Yes, we can touch the cash. Can we touch the vehicle? Yes, we can touch. Furniture, we can touch. Building, we can touch. Motor car, we can touch and see. Cash, we can touch and see. The things which we can touch, feel, and see them are called real accounts. For example, goods purchased. Goods means something might have been purchasing. So whatever goods I purchase, I can have to touch them. For example, I'm purchasing a bag. I have to touch them, have to take them, I have to feel them. Touch, feel, yes, that is called real account. And this real account rule says that debit what comes in. Debit what comes in and credit what goes out. Debit what comes in, credit what goes out. So real account says that, for example, I am purchasing a bag. Can I touch the bag? Yes. So always you have to remember whenever we are talking personal account, real account, nominal account, you have to talk on perspective of business. If it is your business, you have to think in that way. Here it is my business. So in my business, whenever I am selling bag, is the bag coming into the business or going out of the business? Bag
Going out
is
of.
going out of the business. So whenever anything going, we can touch them and see them physically, and if it is going out of the business, we will credit it. So whenever I'm selling bag, what the customer will give to me? Customer will give cash or money. So whenever money is giving, it is also I can touch and see them and feel them. So it's a real account. So debit what comes in. Cash is coming into the business. Cash is coming into the business. So in that situation, I write an entry like this. That is cash is coming. So real account only debit what comes in. Cash is coming in. Cash, when I write like this, is called account. A by C means account, and cash account debit. What I'm selling? Bag. Yes. So bags are goods. Goods means I will sell them daily. If my bag shop is that are I have to sell daily. So instead of I writing daily bag, I'll write sales account. I write a name called sales. I'm selling now. So that is sale. Like this, we will write a journal entry. This is called journal. I said a debit credit. This is called debiting and this is called crediting. Whenever we are writing debiting, you write cash account debit, we will write. And whenever we are writing credit part, we write two. Two will be added. So this will understand in depth when we go in further. Okay. Now that is real account. So personal account rule is what? Debit the receiver, credit the giver. And real account rule is debit what comes in, credit what goes out. The next comes the nominal account. In nominal account, we write that are for namesake accounts. Actually, they are personal accounts, but we cannot write them their names. We write the that expenditure name, such as salaries paid, rent paid, commission paid, salary received, or commission received. For example, salaries. I'll pay salaries, but I cannot write every employee name. So what I'll do instead of writing that, I will debit the salaries. I will write instead of writing the every person name, I will write salaries. So here the nominal account rule is debit. This is called debit. All expenses and losses. Debit all expenses and losses. And credit all incomes and gains. Credit all incomes and gains. Debit all expense and losses, credit all incomes and gains. For example, what I say in the business perspective only, we have to think in the business perspective only. When I am paying salaries to the employees, what is happening? It's an expenditure to me. It's an expenditure. So what I will do, I will debit that. What I will debit, what I am giving to the employees, salaries. So I'll write salaries account debit. Salaries account debit. So whenever I'm telling salaries, what I'm giving salaries means I am giving cash to the employees. Salary, salaries. So cash is again what? It is a real account. Real account rule is credit what goes out. Whenever I'm paying salaries, cash is going out of my business. So I'll write to cash account. To cash account. Next, for example, rent I'm paying. My business building or that business shop, I do not have own shop, so I'm taking that room on rent basis. Whenever I'm taking on rent basis, I have to pay rent to that company. So rent means again it's expenditure to me. So what I will do as per nominal account rule, debit all expenses. So I'll write debit. What I'm paying? Rent. So my entry would be rent account debit. Rent account debit to rent means what I'm paying again. I'll give some cash to the owner of that house or plot or the room where I'm taking or running my business. So I'll write to, I'll not write owner name, I'll write cash account. because I'm giving cash. Again, cash is a real account. Credit what goes out. Rent, when I'm paying rent means what I'm doing? Cash is going out of the business. So my entry would be rent account debit to cash account. So these are the three rules you have to remember to write the journal entries. That is personal account, real account, nominal account. We can make a note. Personal account says debit the receiver, credit the giver. Real account says debit what comes in, credit what goes out. And nominal account, debit all expenses and losses, credit all incomes and gains. Now, can just look at here the rules of journalizing they given us. The same rules, whatever I discussed just now, the same rules have been displayed here. Rules of personal account, debit the receiver, credit the giver. Real account rule, debit what comes in, credit what goes out. And nominal account rule, debit all expenses and losses, credit all incomes and gains. Now let's look at the one example so that you will understand how to write this. Okay. Now classify the following into personal, real and nominal. Okay. So here purchases. Purchase means we'll purchasing something. Is it personal, real or nominal? It falls under purchases means personal, real or nominal. Purchase means what we will purchase. We will purchase something.
Goods,
Something.
a real account.
It comes under real account. We can touch and say. Even sales. Sales also means we are selling something, some goods or some item which we can touch and see. That also comes under real account. Next, interest paid account. Interest we are paying. Paying means to whom we are paying. There is no name if you look at here. It comes under nominal account. Debit all expenses and paying interest paid. So it's an expenditure to us. It comes under nominal account. Next we have salaries account. Salaries is also what? It's an expenditure to us. So it's a nominal account. Machinery account. Machinery is what? It falls under which account? Out of these three?
Real account.
Real account. Why? Because we can touch, see and feel them. Machine. It's a real account. State Bank of India account. Yes, State Bank of India account comes under what?
Nominal.
No. State Bank of India.
And it comes under personal.
Yeah, it's a name of a bank. It's a
Name of
name
the
of a bank. So it comes under personal. Dividend received. Dividend is what? It's an income. It comes under nominal account. Credit all incomes and losses. Here. Credit all incomes and losses. So dividend is an income. It comes under nominal. Rent paid account. Rent is also expenditure, nominal account. Rent received. It's an income to us. Say nominal account. Capital account. Capital is what?
capital means money, so it can consider as real.
Hmm. But who is bringing this capital?
Person.
Person. So we are not writing person name, yes? So it comes under what? Look at here. Personal account. We are not writing owner name. Why? Because if it is sole proprietor, single person, it may be fine. But when you go to the company form of business, there we will have shareholders where we cannot write our shareholders name in the balance sheet. We write capital. So capital is a personal account. Next, drawing is also personal account. Why? Because owner, if he is taking anything from the business, anything taken by the owner or withdrawn from the business, either in the form of cash or kind, who is taking that? Person is taking. So it comes under personal account. Furniture is a which account? It's a real account. Furniture.
Real
Yes, we can touch and see. Sundry debtors account. Sundry debtors comes under which account? You know who are sundry debtors? Whenever I am selling goods to some customers, they are not paying the amount on time. They are paying after 1 month or 15 days. Means selling the goods on credit basis. The people who purchase the goods on credit basis, they are called as sundry debtors. So now tell me, they comes under personal, real or nominal? Goods sold
Goes to
to the customer.
personal.
Personal. They are persons. Now to persons we are selling.
Yes, it's
Even
personal.
creditors account means here as a business, I am purchasing from my supplier and I'm not paying amount immediately. I will pay after 6 months or 3 months. So sundry creditors means is a personal, real or nominal. It is also personal. Why? Because supplier means some person only will be there, na? So when it is a person, it comes under personal account. So this is how we will try have understood. Next comes the accounting cycle. So this is the format of journal entries pro forma. If you just look at here, means we draw a table like date, particulars. LF means ledger folio number, debit amount in rupees, credit amount in rupees. This is the format, how we draw the journal entries format. And we try to do the problems from the next class. Okay. Wait for a second. We'll continue in the next class.
Okay, ma'am. Thank you.
Okay. Okay.